TV.org.
You're watching Book TV on C-SPAN 2, and now joining us live is the author of Flash Boys. Michael Lewis, what is a Flash Boy?
The heroes of the book are the Flash Boys, and they're people who discover that the stock market's got something funny going on and seek to find out what it is, and then build a mechanism to prevent predators in the stock market from getting to prey. And it's called the Flash Boys for a couple of reasons, actually. One is that the solution that the main characters come up with requires them to be faster than the high-speed traders who are the predators in the stock market. So they've got to be, I wanted speed in the title, but I also wanted kind of superhero in the title, because they were these characters at the center of the story. I felt, they're not doing anything unnatural, but they do have these weird powers in the financial markets right now, and the powers are powers to explain complicated things to people, the power to kind of engender trust in others. But the last reason it's called Flash Boys is I knew I wanted flash in the title because the markets have taken this term, and flash crashes and flash orders and flash trading. And I had a title that was kind of an inert title. I thought I was going to call it The Flash Trap. And I was driving with my kids in a car one day, and they said, "What's the book called that you're working on?" I said, "Flash Trap." And they said, "That's really dull." And I said, "Well, you come up with a better one." And they said, "What's it about?" And I said, "Well, it's kind of about these guys on Wall Street who figure out rich people on Wall Street are stealing from less rich people or middle-class people. And they get upset about it, and they try to do something about it." And my kids go, "Rich people are stealing from other people?" I said, "Yeah, that's awful." I said, "Well, yeah, but that's what's happening." He said, "And they're going to fix it?" I said, "Yeah, they're going to fix it, because that's like Robin Hood or something." I said, "It's kind of like Robin Hood." And they said, one of my children said, "Why don't you call it Flash Boys?" So I thought, there's my title. I never told my publisher that, where it came from, but that's where it came from.
How, in your view, are people stealing from others on Wall Street? Well,
stealing I think everything is going on, as far as I know, it's legal. I don't know if what's going on is illegal or illegal, but the stock exchanges have become unfair places for investors. And it's happened pretty rapidly over the last 6-7 years, where the 13 public stock exchanges, they're all scattered through New Jersey. High-speed traders are provided by the exchanges for fees, for lots of money. The high-speed traders pay the exchanges for special fees, which enable them to see movement in stock prices before ordinary investors. So they know it's only a couple of a millisecond advantage. It's the amount of time involved is very, very slight, but they know today's prices, and we know yesterday's prices, and the ordinary investor knows yesterday's prices. The analogy is, it's a bit like someone knowing the result of a horse race before it's been run, walking into the track and starting to be able to bet with other people who are betting on the horse race. So there's this unfairness in the middle of the system. So that's the problem, and that problem is nobody quite knows how big the problem is in terms of like the sums of money that are being essentially taxed out of investors by Wall Street intermediaries. But it's billions of dollars a year.
Because of these milliseconds.
Because of these milliseconds.
All right. This is something you write in your book, Flash Boys, Mr. Lewis. You write that over the past decade, the financial markets have changed too rapidly for our mental picture of them to remain true to life. The picture I'll bet most people have of the markets is still a picture of a human being that a human being might have taken. In it, a ticker tape runs across the bottom of some cable TV screen, with alpha males in color-coded jackets standing in trading pits, hollering at each other. That picture is dated. The world it depicts is dead.
Yeah, and in fact, that's the picture I kind of had in my head when I got into this story. I didn't have any great sense of what had happened in the market. It was only 3 or 4 years ago that you started hearing this phrase, high-frequency trading. And it's really only in the last decade that the markets have become fully automated, meaning that all trades are essentially matched inside of computers rather than by human beings on the stock exchange. And the New York, it's funny because it's a problem and it's also a literary opportunity. to describe but what this new world is. But you can see how hard it is for people to get their minds around what not just the stock market but all the financial markets have become, because they cling to the old picture. You see, when you watch the TV and there are reports about what's going on in the stock market, there are pictures of people on the New York Stock Exchange as if those people are actually at the center of the market still. The old picture is still sort of being used because the new picture hasn't been drawn. So one of the things I'd hoped to do, it was almost by the by, but I thought it would be, is to leave a reader with a sense of a different sort of picture. But the problem is, in order to generate that mental picture, you almost have to imagine time the way a computer does. That's what's happened. Is that a computer can make 1,000 trades in the time it takes a human being to make one. Computer time, it's a bit like geological time, like the time it takes to form mountains and valleys and rivers, and it's hard to get your mind around what can be done in a millisecond.
If you were to draw that picture today, Michael Lewis, would you draw it at the New York Stock Exchange on Wall Street, or would you draw it in Mahwah, New Jersey?
Well, so I would draw it in Mahwah, New Jersey. I mean, the exchanges are all housed in data centers, very heavily guarded data centers, in Weehawken, Secaucus, Carteret, and Mahwah, New Jersey. And when you go in them, what you see is there are boxes of black boxes. There's rows and rows of black boxes. But one set of the black boxes is the exchange itself. It's called the matching engine, where buyers and sellers are connected. And where kind of price discovery happens, what the price of a stock should be, because the buyer and the seller agrees to meet at that price. Then you have around that matching engine the boxes of the high-frequency traders who pay $50,000 a month, $100,000 a month, whatever it is, to connect a line directly into the box to get information about what's happening on the exchange before everybody else.
What is front running that you talk about in Flash Boys?
So front running is the idea of it is almost like tickets. Imagine a ticket scalper, someone who figures out that the show is going to be sold out, runs up, buys tickets, turns at the box office price, and turns around and sells them at double the price to people who walked up to see the show. In the stock market, what is happening often is that faster traders with faster machines are able to anticipate orders to buy and sell stock from investors, in every kind of investor, little investor to big investor, and buy the stock, say, before them, and sell it back to them at a slightly higher price.
And you're talking about a millisecond, 1/1,000,000th of a second.
Even millisecond is a thousandth of a second. But we're talking microseconds too. I mean, actually, high-frequency traders now are making decisions to improve speeds by nanoseconds. So a millisecond is a thousandth of a second, a microsecond is a thousandth of a millisecond, and a nanosecond is a thousandth of a microsecond. So the increments of speed are mind-numbingly small. It's very hard. My point is that the ability to divine your intentions and act faster than you creates this opportunity for front running. It doesn't mean it happens every trade in the stock market, but I think it happens quite a lot. And what was interesting to me about this story, about this young man, this young Canadian who sort of figures out for himself what's going on. He's a trader on Wall Street, but he finds himself being front run, and he can't figure out quite how people are doing this, is that once he figures it out, and he wanders around even the offices of even the most sophisticated investors in America, big hedge fund managers, for example, he finds that everybody senses there's this front running going on, but nobody knows the nature of it. No one understands why. No one understands it's in the plumbing of the market. So Bill Ackman, big hedge fund manager in New York, who often buys and sells big chunks of companies, told me that he said before Brad Katsuyama, the main character of the story, came into his office, he thought he had an insider trading issue, that he was thinking of buying some stock. He was going out in the market to buy some stock, and the stock would move on him, that he'd try to buy it and it would go up before he could buy it, as if someone knew that he wanted to buy it and then sell it back to him at a little higher price. That captures the flavor of front running. It's people learning what you want to do before you do it, and doing it to your disadvantage.
Michael Lewis is our guest. His most recent book is called Flash Boys. Of course, he's also the author of Moneyball, Blindside, and several other books. You might have seen him on 60 Minutes last week, and that piece on 60 Minutes, we have him live here on Book TV to take your calls. We're going to put the numbers up on the screen. 202 is the area code, 585-3880 if you live in the East and Central time zones, 585-3881 for those of you in the Mountain and Pacific time zones. Now, if you can't get through on the phone lines, you can get through on Twitter. You can send a tweet. @BookTV is our Twitter handle. You can also make a comment on our Facebook page, facebook.com/BookTV. And finally, you can send an email to booktv@cspan.org. What's your history in the financial markets, your work history?
My personal history?
Yes.
It was brief. It was brief, but lucrative. I stumbled into a job at the now defunct firm of Salomon Brothers when I was 24 years old in 1985, and I was trained by Salomon Brothers for 6 months, and then I spent 2 years. And nobody called them this at the time, but I was essentially a derivatives expert, is what I was supposed to be, and bond salesman. So I learned. This was when the financial markets were starting to get very complicated, and financial options and financial futures were starting to become the rage. And my job was to explain them to investors. So I was given a crash course in what this stuff was, and would go out and proselytize. I quit in 1988, and I wrote a book called Liar's Poker about the experience of working on Wall Street. And then since then, I've been an interloper. I mean, in that I've written about a lot of other things: sports, my family, my high school baseball coach, whatever it is. I mean, I've been in politics. But since the financial crisis, I found myself drawn back into Wall Street to write big narratives, and there've been 3. A book called The Big Short, which was about the credit crisis. A book called Boomerang, which was about the way the crisis expressed itself in different cultures around the world, and how that showed you something about the cultures. And Flash Boys, which is about the way the stock market has evolved really almost since the credit crisis. And my interest in it is different than when I was working on it, obviously. And these books, I think, are even a little different from Liar's Poker, but they are what's happened is that because of my history of writing about Wall Street, I've had some access to, it's really just, I think, fabulous narrative stories that happen to have emerged from Wall Street in this time. And Wall Street, I think, at this moment is a really rich vein of material for a storyteller.
Well, in Flash Boys, one of the themes throughout here is a federal regulation called the Regulation National Market System. What is that, or Reg NMS? What is that, and where did it come from?
So Reg NMS was implemented in, I think, late 2007, and it was a response to the fear of unfairness in the market, the possibility of unfairness caused by the fragmentation of the market. I mean, it's the stock market. It wasn't that long ago when the stock market was basically the New York Stock Exchange, right? And there was this thing called NASDAQ where some tech companies traded. And the stock either traded in one place or the other. So, that's changed. The stock market is now 13 public exchanges and 40-something private exchanges called dark pools run by Goldman Sachs or Morgan Stanley, in which you can't really see the trading. And it's
or
not
participate.
Really, well, you could participate in the sense that if you're a big investor, you can give the order to Goldman Sachs, and they may execute it in the dark pool for you, but you can't see in real time how your trade fits into the larger trade in the marketplace. So there's a lot of opacity, right, and complexity. The market's fragmented, and you can't really see what's going on in it. So to protect investors against this, the SEC came up with Reg NMS, and Reg NMS says that it's against the rules for a broker who handles a stock market order to trade outside whatever the national best bid or offer is. So let me explain that. So let's say you, the investor, want to buy shares in Microsoft. And if you took an agglomeration of all the market prices that were out there, of Microsoft in the 60-something or 50-something markets there are. And you add it all up, the offers to buy and sell. The market in Microsoft is $29, $99, $30. So some people are willing to buy at $29.99 and some people are willing to sell it at $30. If you come in to buy, the broker's not allowed to execute your order at a price higher than $30. So, because there's an offer there of $30 somewhere in the market. So it was to protect investors from being cheated by the complexity and opacity of the system. The problem is with Reg NMS, and why this whole story really begins with it, is how the best bid and offers are calculated. They're calculated slowly. So it takes a long time for all this information to be gathered.
What do you mean by slowly? Are you talking a day? Are you talking a week? You're talking a minute?
You know, it's funny. So we're talking milliseconds. We're talking milliseconds differences. But the technology is slow. Nobody has an interest in making it. Nobody on Wall Street has an interest in making it faster. So that market, that official market, is a stale market. The people who have faster access to information of what's going on inside all of these exchanges know that maybe Microsoft is actually, but between the time your your order has gone in and it gets executed, the Microsoft would have collapsed the next millisecond. And it's down to, rose a lot. Is that right? No, it's collapsed. I'm already getting confused. It collapsed. So that the high-frequency trader can now buy it cheaply and sell it back to you at the stale price of $30. So that's what happens. So the meaning, the intent of the regulation was very good. It was like to stop investors from being screwed by the complexity of the market. The problem is the market figured out a way to game the regulation by creating two markets: the slow market that investors see, and the fast market that a handful of insiders pay to see. And the further problem was that once that happened, that gap opened between this old stale official price and the insider's knowledge. The sums of money that were made from this was vast. I mean, I don't know how many billions a year. No one knows. Their estimates that are thrown out there, they're all nonsense. The closest I've seen to something I believe is what my main characters start to calculate from the individual predatory strategies, but it's many billions of dollars a year. That once those billions of dollars are made by those traders who are paying the exchanges for the faster and faster information, and who are paying the brokers, the banks and the brokers, for the right to trade against those orders that are kind of dumb in the sense that they're all they know is the slow market. Everybody's in on it. The banks and the brokers get paid a lot of money by the high-frequency traders. The exchanges get paid by the high-frequency traders, and the high-frequency traders obviously get very, very rich. The investors the system is basically opaque to the investors. They have a hard time figuring out what on earth is going on with their stock market orders, and the skim is so slight that they don't really feel the pain, but collectively the pain is vast. So an ecosystem arises, and no one on Wall Street has any interest whatsoever in exposing it or talking about it. And this is why, to finish this soliloquy, the stock market has weirdly become incredibly secretive. Why it takes detectives to go in and figure out what on earth is the stock market, how on earth does it operate, because people on the inside, and I mean this like everybody on the inside, really doesn't want to talk about it very much.
Well, Michael Lewis, one more question before we go to calls and tweets and emails. This is about the culture of Wall Street. You quote one of your main characters, Ronan, as saying, "It's a whole industry of BS." And in reading the book, I noticed...
He's a Wall Street person.
And he's a Wall Street person. But I noticed it was white male, and the F word is thrown around a lot.
Yes, it is. Every time I come on C-SPAN, I'm called out about that. I admire your willingness to attack those who use bad language. And defend the language, the purity of the language. But it's true. It's a lot of males. It is in some weird way more of a men's world than even when I was there. Now, in some ways that's not true, but this world of tech and trading is ridiculously male. I've said many times that I thought if you wanted to reform Wall Street, just get rid of the guys and put in women for a few years, in actually the decision-making jobs, the actual decision-making jobs, and everything would be cleaned up. Everything would be fine. That the women would not do what the men are doing. That there's something about male overconfidence, testosterone, competition, that when it connects to the financial markets is toxic. But anyway, Ronan Ryan is his name. He's Irish. So a lot of the characters in this book, the people who are kind of the radicals who are trying to fix Wall Street, are immigrants. But Ronan Ryan is an Irish guy. And his whole life, from the age of 19, when his family moves him to, or 16, when he moves him to Greenwich, Connecticut from Ireland, he discovers investment bankers and financial people, because that's who lives in Greenwich, Connecticut. And he wants nothing more than to be a Wall Street person. And he spends 12, 13 years desperately trying to get jobs on Wall Street. And he can't. All he can get is jobs helping guys who call themselves high-speed traders get faster by knowing the technology of the. He knows about technology. He works in telecom. He knows where fiber optic lines are laid through New Jersey. He knows what boxes you buy to make your trades go faster. They call him speed in a box. He's a high-frequency trader in a box. So he spends all his time trying to get himself on Wall Street, and when he finally gets hired by the hero of the book and is paid $1 million a year to be kind of a big figure on a Wall Street trading floor, after about a year he says, why did I even want to be here? You know, he can't believe the mystique was so different from the reality that he becomes almost instantly disillusioned.
Michael Lewis is our guest, and Bernie from Howard Beach, New York. You're the first caller. Hi, Bernie.
Yes. Thanks, Mr. Lewis, for writing the book. I want to point out something for you. You probably know all about it already, but it's been bothering me. Level 2 quotes, real-time level 2 quotes. My feeling is that I used to be able to look at that and make a decision as to the depth of the market. But it changes. The bids and the asks and the sizes change so quickly that it's become meaningless to me. In other words, it's my contention that these high-speed computers are corrupting the information.
Can I ask him for a sec?
Sure.
So when you say you used to be able to look and make a decision, where are you trading? What are you looking at when you look at your screen?
I'm looking at level 2 quotes. I'm seeing the bid and the ask and the size.
But who's providing you with the information?
AccuTrade.
Okay. Okay.
Bernie, what do you do for a living?
I'm retired.
Okay, but you're an investor or a trader?
I used to be. Not anymore.
Okay. What is a level 2 quote? What does that mean?
Are you asking me?
Yes, sir.
A level 2 quote is on an investment screen. You will see a list of, you'll take a stock, any stock, IBM, and they will show you a list of the orders at different levels, often in pennies, in $100 plus 10 cents, and on the other side, $110 and 11 cents, and they'll tell you how many shares are offered on each side. And I used to be able to see that on a steady basis. In other words, I could digest the information. But now these numbers change so quickly, the size changes and the bids change so quickly that the information is useless to me. So I've stopped.
It's interesting. There's a big discussion here, and what we really want is the subjects of my book here to explain what he's talking about, because they do it better than I. But the exchanges enable the high-frequency traders to use quotes tactically. So to submit offers to buy or sell stock, not because they want to buy it, but to make the market seem something it isn't. So he would be looking at, what he's talking about, I think, is that high-frequency traders will spoof the market, that they'll make it look like they want to buy, that there's a lot of demand out there for the shares in Procter & Gamble, but they're able to move so fast in and out that the minute any person like him is trying to act on it, it's gone. So the information's meaningless. So and that in itself is, I mean, that's a problem between traders in some way. It's acts of deception. Short-term traders trying to deceive each other about what the market really is. But the bigger problem spawned by this is that the exchanges, to enable that kind of activity, have to make the exchange itself, the software, incredibly complicated. I mean, to satisfy the needs of the high-frequency traders in all the tactics they want to deploy and fooling people into thinking the market's one thing rather than another, they create instability in the system. And this is why, I mean, I don't mean to expand on this too much, but what was one of the things that was really interesting to me about this story was that one big Wall Street bank, Goldman Sachs, when presented with the story that Brad Katsuyama, the main character of this story, has to tell, and a choice, an exchange that is simple and fair and designed with the sole purpose of making creating equality among all investors, not giving one trader on the exchange an advantage over another. That Goldman Sachs basically said, you know, this is a moment of choice for us. I mean, it's a gut check moment for us because we actually think, the heads of stock market trading at Goldman Sachs, actually think that what's been done in the U.S. stock market to accommodate high-frequency traders is creating conditions for a catastrophe. And if we don't actually make the right choice here to try to direct the stock market onto fair exchanges, that this catastrophe is going to happen at some point, and we're going to get blamed for it. And it's all a result of like changes in the plumbing of the market. That is really just to accommodate, to maximize profits for high-frequency traders.
Michael Lewis, Don Mattern emails in, if front-running is illegal, why isn't writing the software for it illegal?
Great question. So I think one of the questions I asked myself when I was writing this story was, why, you always ask this question, why is this story available to be written? Why hasn't there been more outrage about this subject? And it wasn't that nobody had noticed that like the exchange, something was weird was happening in the stock market. A lot of people had noticed, and insiders had really noticed. And it wasn't that every now and then someone had not cried out about it. There were some gadflies in the industry and critics in the industry, but it was that people were numbed. The public generally was numbed, and I think people inside the markets were numbed by two things. One, in the course of this story, the stock market's been booming. So whatever grift there is, whatever skim there is, isn't really noticeable in the context of a market that triples from the financial crisis. Everybody's making money, so they aren't thinking very much about like, is this sound? But the second thing is his point, which is what's in between the lines of what his question, is that when it's done by a computer, people have, it's not just deniability, they have a sense that like there isn't willful human action behind it. It's like just the computer did it, the computer's doing it. And they also have a level of complexity that's hard to parse. To actually understand the front running and to prove it kind of thing, you actually will need to parse the algorithms written by high-frequency traders. So it creates a smokescreen, and it creates, I think, an internal moral defense in a funny way. That if you're directing a computer to do something, I think a human being will direct a computer to do something that they would never do themselves if they actually had to physically do it.
Linda emails into you from Norcross, Georgia. What do you think of the idea of collecting a small fee, 1 or 2 cents, on each stock trade and then apply the fees generated to our federal and state needs? Even the national debt, pennies would be turned into billions of dollars by virtue of the volume of transactions.
So the issue of taxing, to levy taxes naturally is distortive in a market, right? And maybe this is a good way to distort the market. But as a solution to this particular problem, any sort of tax is going to have all kinds of unintended consequences. It may actually, get the bad guys kind of thing. You may get some satisfaction there, but it's going to have all sorts of unintended consequences. And then I have to think about what that tax would do. There is a solution. This is what's so great about this story. It's like a choice our society is now being presented with. And it's a very small part of our society. It's our stock market, but it's actually all of our financial markets. And but that market is so important and so reflective of who we are. And the choice is between fairness and unfairness. And this fair exchange has been built. And I think what is needed is for as the solution to the problem is transparency. It's people understanding how their stock market orders are being handled, and people being given a choice about which way to direct their stock market orders in spite of the wishes or the needs of their brokers. And if they choose whatever market has actually been created is fair, you will gut this system. You will reform the system in a way, say, Occupy Wall Street never would have.
Well, R.C. Shuaj tweets into you, do we really need hedge funds and derivatives and leveraging?
Do we need them? No, we need love. No, right? We need food and water. But do we need hedge funds and derivatives and what was the other one?
And leveraging.
Leveraging.
I.e., he's going to the complexity of it.
Right. So that's a very good. This is, I think, a very good point. This is sort of a useful discussion. And the broader discussion is, if you look back in the innovation that's occurred in the financial system since the early 80s, you can see that things were created, credit default swaps, collateralized debt obligation, specialized access for high-frequency traders that looked like innovation, that were masquerading as efficiencies, and that were accepted as such because, one, they were very complicated, two, the people who were doing them were making more money than everybody else, and three, we have this metaphor. In every other kind of every other aspect of our economy, innovation always seems like kind of a good thing. It is really true that innovation in the financial sector can be malign. It can seem like it's a progress and is not progress. I would not list as a malign influence the structure of a hedge fund. It's just the way it's just a structure for a money manager to use. Leveraging, depending on where it is, can be useful actually, but the problem is that we have developed too much of a taste for it, and we don't recognize the social costs of it. So that's a problem. And derivatives, well, some of the derivatives actually should have never been allowed to be created. I think if you could kind of, I don't know, if there could be a watchdog who had to. The problem is once you introduce the government into the process, you introduce a whole other set of problems. But if you could wave a wand over Wall Street and never have created credit default swaps, we would all be better off.
Michael Lewis, from the CBS News site on this story from 60 Minutes, I don't know if you had a chance to look at some of the comments that people made on the story, but here's one from Star Flyer. I like 60 Minutes, but this piece is a crock. Maybe, if it was true, it affects large buyers, 1%ers, and mutual funds. However, I can limit any buy I put in by price, and if I don't get it, that's fine with me. From what I got from the show, we're talking a few pennies a share.
Yeah, we are talking a few pennies a share. So so let's talk about this. Let's talk about his question is his point is the damages are minor, if there are any damages at all. And the person who says that, rightly, no doubt is thinking, there's been incredible improvements in my ability to trade in the stock market because of technology. Totally true. We are much better off because of computers in the stock market, trading in the stock market, than we were before it was automated. It's much less expensive to trade. The problem is that instead of the benefits of the technology flowing to investors as it should have, to customers, the way, I don't know, the benefits of technology flow to people who make telephone calls. And they're incredibly cheap to make now compared to the way they used to be. Wall Street has captured some of the benefits for itself totally unnecessarily by introducing basically this inefficiency, this front runner in the market. So then the question is, what's the cost of that? What is the cost of letting Wall Street insert itself unnecessarily into lots of transactions between buyers and sellers of stocks and take out a few pennies each time? Well, you could say, yeah, for him, it's not that big a deal. And he's very happy that the computer works better than the people used to work. And he's using whatever he's losing, it's trivial to him. Over the market, a few pennies a share, it's not even that probably, it adds up to many, many billions of dollars a year. So what's that? So let's say it's $10 to $20 billion a year, whatever it is. That's a tax on investment capital. Just a pure tax levied by, a tax on the economy levied by the richest people in the economy. So that's offensive. But maybe who cares? Even if it's $20 billion, $20 billion, who cares? I'm willing to go that far with you. if we've had a couple of glasses of wine. But I'm already starting to get a little worked up. Then I think, what have they done in order to secure this 20? What have they done to the markets, to the structure of the markets, in order to make the $20 billion grift possible? They've compromised the structure of the markets, made it, and this is a collaboration of banks, exchanges, and high-frequency traders. They've made it much, much less stable than it could and should be. They made it highly unstable. We have things like flash crashes. We have IPOs going poof. We've got outages at the exchanges. What does that cause? That causes a decline in trust in the markets. That gets right at the core of capitalism. The whole thing runs on trust. So what's the cost of this? Well, very hard to measure, but I can tell you this, that it is not cheaper for corporations to raise capital in the stock market, because when the trust declines, it goes up. So what happens then? Corporations don't invest as much, so it costs them more to raise the capital to invest. Jobs don't get created. You start talking about a broad economic effect. All right, let's say you're willing to go that far and say, who cares? A little bit of growth in the economy, a little bit of trust. Who cares if we trust Wall Street, et cetera, et cetera. So let's say we go that far. We are creating, in our financial system, and have for now 20 years, a model of success in life that is pernicious. And people are able to feel like, and are celebrated as great successes, when what their job is to figure out how to take money, basically, from middle class people and transfer it to themselves and to rich people. So what does that do? It compromises our educational systems. The best schools in the country send people onto Wall Street to do this. It perverts ambition. It creates, at bottom, it's a moral problem. It's a technical problem, it's a moral problem. And this problem and what you get in the end is what we have right now, which is a financial system that nobody trusts, that can't persuade anybody to trust them because they've watched what they did in the financial crisis, and whose interests and incentives are completely out of line with those of the larger society. There are many, many good people in the financial system, great people. Some of my best friends work on Wall Street. They don't want that relationship. We don't want that relationship. The society can't function if the interests aren't aligned. Because then what you get is people with money influencing the culture, influencing the political process, the direction of regulation, and you get two beasts that can't collaborate. And that's the problem we're facing with, and this is a microcosm of the problem. So yes, you're only losing a penny, but the story is much more complicated than that.
Up next is Sean in Battleground, Washington. Sean, thanks for holding on. You're on with Michael Lewis.
Mr. Lewis, you were just touching on it, but it seems that conservatives like Charles Murray and all the conservative think tanks, what they're doing is they project onto poor people all of the corruption and wickedness that they themselves are guilty of. 15 years ago, in the summer of '99, Roger Ailes was a guest with Brian Lamb, and I called him up, and Roger Ailes, of course, was instrumental in starting Fox News and CNBC and Rush Limbaugh's career and all that. And I asked Mr. Ailes about Spear, Leeds, and Kellogg, about this specialist firm that was front-running the tape. And, of course, he blew off my question. But then 5 years later, the SEC levied something close to $250 million worth of fines on the specialist firms for front-running the tape. Yeah. So I was wondering if you could address those questions of conservatives projecting. I think the country would be surprised to know that our nation is run by cocaine-snorting frat boys. It's really a crime if Liar's Poker isn't turned into a major motion picture. I just saw The Wolf of Wall Street yesterday, and I think Liar's Poker would be even better. So, and then there's this legacy.
All right. Hey, you know what, Sean? We got a lot of callers on the line. Let's leave it there. Thank you.
So, can I run in just one particular direction with this, other than actually recommend?
Anywhere you want.
I'll start by recommending Hollywood listen to what he just said, because it would be great if Liar's Poker made a movie, but I don't have any control over that. And the thing the one worry I have for the story I've just told is it's clearly caused an uproar. I mean, there's more of an uproar than anything I've ever written in my life. The only thing it reminds me of, actually very closely, but it was in a smaller sphere, was Moneyball, which disrupted the world of baseball. I mean, you had a disruptive, essentially entrepreneur rethinking an environment. And in this case, you have disruptive entrepreneurs introducing reform through the market in Wall Street, which is a much bigger stage. But my fear is that because it'd be party politicized, that the story that when Eric Holder, as he did yesterday, announces, as they should, a Justice Department investigation, that all of a sudden it becomes liberal versus conservative. It becomes Democrats against rich Wall Street guys. And then the Republicans line up because they can generate campaign funds from Wall Street, behind Wall Street, and find arguments to make that are maybe spurious arguments, but nevertheless, it becomes, we get back to this poisonous sort of, we're back in the poisonous debate where everything is zero sum. What I love about the story is that it isn't that way. Conservatives should see that this is a market solution. That these people, I mean, the spirit of the heroes of this book it's a very conservative spirit in a way. They're not looking to the government to fix the problem. They think the markets can fix the problem. I think so. So then the broader question of like who's to blame for whether Wall Street is properly regulated, I think it's more complicated than a party political problem. I think that the problem is that for a bunch of reasons, Wall Street all of a sudden started making much more money than it used to make. I'm talking about a break happened in the world 30 years ago, and it's very hard for a society, for regulators to regulate an industry in which people are so much better paid than the regulators. There's probably some law out there that if the person who's being regulated makes more than 10 times the regulator, that the regulation will never happen. There's something like that. But and added to that, you're dealing with, in every case where regulation is called for, it ends up being an arcane and boring argument between specialists. And so much smoke and dust can be thrown into that argument by both sides. And the public can't participate. It's too complicated. I mean, unless you're going to spend your whole life paying attention to that one little regulation. So it ends up being, by nature, a kind of backroom deal. And when you have a backroom deal and there's a lot of money in the front room, it's hard for those backroom deals to always achieve what the greater society would like them to achieve.
Colleen, Portland, Oregon. Hi, Colleen. You're on with Michael Lewis, Book TV.
Hi.
Hi.
You know, I'm not worried about Goldman Sachs, but I'm wondering how you can fix this problem and not spook the market, the only market we can invest in, and not jeopardize the portfolios of the little guy.
So the market is pretty clearly already made uneasy by things that have happened in the market. I mean, it's the things like the flash crash. The problem of confidence in just the market structure is not a problem of appearances. It's a problem of reality. If the market structure is inherently unstable, eventually, even if people temporarily have confidence, that confidence will be shattered. So how do you fix the problem? You expose the problem, and you work with people who have a solution to the problem. And so that's what this story is about. It's about fixing the problem. It's about people who actually figured out a way to make the market stable and reliable and trustworthy. And I'm not worried about Goldman Sachs either, because they've thrown their weight behind it. So as have a number of other actors in the market. So I think that I feel like, it's funny. I feel like the first half of this book is kind of depressing when you're learning about what actually happened. But the second half, about these guys figuring out the solution, is extremely hopeful. And that the choice is now so stark between fairness and unfairness. And there's so much noise about what they've done. I think it's all very hopeful.
Somebody we haven't talked about. Who is Sergei Aleniakov?
So Sergei Aleniakov is how I personally became interested in writing the book and telling the story. And this is the first time high-frequency trading caught my eye, or really anybody else's. He was a high-frequency trading computer programmer at Goldman Sachs. in 2007, 2008, and he leaves Goldman Sachs in, I think, 2009. And before he leaves, he mails himself some of the computer code, some of which he'd been working on, some of which he had not been working on. And Goldman Sachs sees that this former employee, he'd quit to go work for a high-frequency trading firm. And Goldman Sachs panicked, and instantly, like in a matter of hours, days, calls the FBI, and the FBI instantly arrests Sergei Aleninkov, and a trial is held eventually, and he's sentenced to 7 years in jail for stealing Goldman Sachs' computer code. And when it caught, in the end, his conviction was reversed, but only after he had spent a year in jail. And what caught my eye was, I had like 3 questions at once. One was, we've just come through this financial crisis with which Goldman Sachs had a lot to do. And the only person who ends up in jail is the person that Goldman Sachs once put in jail. I thought, that's very strange. I mean, why? So what did he do? What was that? What was such a big deal that he deserves to go to jail, but people who help tank the entire economy don't have any kind of criminal kind of exposure? So the second thing was that the prosecutors who went after him said that after he was arrested, he couldn't be let back on the street on bail because it was so dangerous to have someone who had access to this computer code, because the code could be used to, I can't remember the language, but the effect was like crash the financial system, like disrupt markets. And I thought, and they said if this code was in the wrong hands, that would happen. And I thought, Goldman Sachs is in the right hands? I mean, so we're supposed to believe that these Wall Street firms have code that could be used to do really bad things in the markets, but that's okay. And this guy who's left in his hands, well, we can't trust him. We have to put him in jail so he doesn't go hit a button on a computer and crash the markets. So that made me curious. But finally the thing was, he was he engaged in high-frequency trading, which a term which never hit, I don't think it hit the newspapers. So what's that? Wall Street generates these terms, and then everybody just says, yeah, they know what it is. But I didn't know what it was, and most people I know on Wall Street, when I asked them, they didn't know what it was either. And that was clearly so valuable that it caused Goldman Sachs to hit the panic button. It was to call the FBI. Nobody does that. I mean, you do that, and you don't really do that on Wall Street. There are other ways to handle the problems. So I started to ask around about what this was, high-frequency trading. And this is where I stumbled upon Brad Katsuyama, the main character of the story, because at that point, he had been wandering through the offices of some of the biggest, most sophisticated money managers on the planet, and telling them how he had found, what he had found out about what high-frequency traders were doing in this market, and Goldman Sachs was at that time among them. And people said to me, look, there's a lot of noise about this subject right now. There's no one who can describe this in 2009 like this guy. And they say he works for the Royal Bank of Canada. I have no idea why he knows so much or how he's figured it out. It's insane. He's Canadian. What does he have to do with any of this? And it led me to him. And I went to him in the first place just to figure out whether what Sergei Aleninkov had taken was, whether it was really valuable or what it was, or should he be guilty. And he helped me understand that. And he helped me understand the tragedy that happened in the judicial process, which couldn't understand any of this. And the jurors threw him. I mean, there was no way anybody who sat through the trial left with a true understanding of what had happened. But in him explaining Sergei Aleninkov, he was explaining this thing that had happened in the stock market. And I thought, my God, what a story. So Sergei Aleninkov became a book. I mean, he became a magazine piece. Some of his story is in the book, but the guts of the story was this young man who was trying to figure out and reform the entire U.S. financial system.
We're talking with Michael Lewis, Flash Boys. This is his most recent book, Jim, Dubuque, Iowa.
Thank you very much for your book. It's brought public attention to this phenomenon, which has been a problem for a long time. I'm wondering if these high-frequency traders are playing any part of the obvious manipulation of the gold and silver markets, for example, where they'll offer to sell some astronomical and undeliverable amount of metal and then trigger sell stops and manipulate the market lower, on behalf of possibly even governments. This is threatening the global monetary system.
Okay.
Are they any part of that?
So the short answer is I have no idea, but in the interest of trying to say something that doesn't bore the people who are listening, there's an observation that you can't, one who has been watching the commodities markets, the foreign exchange markets, the interest rate markets over the last 5 or 6 years can't help but make, and that is, it is amazing how much manipulative activity in the prices of things has been going on, or accusations of it. I mean, the LIBOR scandal in London is this, the foreign exchange trading scandal, and it raises a question: Why is this just always been going on and we just didn't know about it, or are we in this great age of manipulation of markets by the giant actors who now sit at the center of the markets, and the stock market being one of those markets? And I don't know the answer to that, but I have a suspicion. And my suspicion is that broadly what's happened in the financial system is that technology, your computer, information technology has greatly reduced the necessary role of Wall Street. That it isn't what it used to make Wall Street used to make money doing, standing between buyers and sellers, is not needed anymore. And so the firms, the actors on Wall Street, have been forced to find other outlets for revenues. And one of those outlets is creating complicated things that the people they sell them to don't understand, and they can take the other side of the trade. Another may be mucking around in markets in ways that really they shouldn't be mucked around in. But I do not know the answer to his question.
After all this research, Michael Lewis, what's your understanding of the market? Do you think you understand it fully?
No. It's so. I mean, the stock market, I understand it well enough to write the story. I'm convinced that the deepest understanding of the market is held by the main characters of the book. But it's breathtakingly complicated. I mean, there are, so for example, there are 150 basic different order types now that high-frequency traders can use to submit their stock market order, most of which are designed to feint, nod, and create perceptions that not to trade, to move the price around. And I don't know all of them. I know 8 of them. But I know enough of them to say, oh my, that one of them is allowed is incredible. So I could not give you an authoritative account of all the order types. But I can give you a broad description of what they do and a few examples. I could tell you this, that I know now enough about the stock market that I know I don't really want to know anymore. And that what really needs to happen is it needs to be simplified and clarified. That this market sits at the center of our economy. It needs to be understandable. It shouldn't be a secret. It doesn't need to be this complicated.
Are you in the market?
Yeah, absolutely. My first reaction to learning what I learned when I started to investigate the story was I had to just take some of my money out of the market completely, just so that if this calamity that seems like it's possible happens, I don't feel like a fool for having had these people tell me to watch out for it and not do anything. But I didn't do that very, very much of my savings. What I don't do is actually bother to pick stocks, or I think it's a fool's game. I certainly, for me, I just don't have the interest. I just try not to lose my money. So I am in the market in 2 ways. I basically buy index funds, and another version of this is I give my money to Warren Buffett and let him worry about me. So I buy shares of Berkshire Hathaway, because I figure whatever happens, he will be positioned to exploit it. And that whatever happens, he'll be in a position to defend me against it. And what I really want to do is not think about this. I want to think about writing stories. So that's how I'm in the market.
Bill, Tucson, Arizona, please go ahead with your question or comment.
Yes, I have not read your book, but I've been involved in the market for over 50 years. My question is regarding the corporations that have their stocks listed on the New York Stock Exchange and other exchanges, and what their reaction is to high-frequency trading and the feeling that their stock prices are being manipulated by these high-frequency traders.
That is a great question. It's this question that, if I had been a better writer, I would have found some way to weave into the book, because you look at the interested parties here, and the book is framed as a story, essentially a dance between predator and prey. The prey as framed in the book being investors in the market, people who are buying and selling stock and holding the stock for more than a millisecond. And the predator being the high-frequency traders. But it is true that there's another party to the transaction who you never hear from, and probably should hear from, and that is like the real economy out there. The purpose of the stock market is to channel investment capital to people who can put it to productive uses. All this nonsense has nothing to do with that. It's a lot of unnecessary financial intermediation. So how does some corporation feel about its stock? I can tell you that the people at Facebook were not happy about their IPO. I mean, I know I've talked to people about that kind of thing where the glitches were so obvious that they throw up their hands and they say, how can it be like this? But I think that's a constituency that needs to start to speak up, to go to Capitol Hill and say, look, this meddling, this mucking around in the market, it may not be in the dollars, how much dollars these guys are taking out, that may not be the big deal. We need this market to be sound and stable. We need our stock prices to feel like they're reflecting something. So this is a long way of saying it's a part of the story I just never got to. I never actually went and interviewed corporate executives about how they felt about these people meddling around the stock prices. And my guess is in most cases they don't know about it. They're not that aware of it. It's not high on their list of concerns. They're busy running their business, all right? But maybe now they'll get interested.
John, Madison, Alabama.
Hi, Mr. Lewis. I certainly appreciate hearing what you had to say today and what you've done about your book. Question I've got is with the Federal Reserve and the U.S. Treasury and I'm trying not to be political like you said earlier too. I agree with you about that. But with all of the things and the money that's being put in by our government, how is this impacting that? And then is this making it more unstable, or is that anyway? If you get the gist of my question.
I think I do. I mean, I think the question is the stimulus that has followed the financial crisis creating instability in the financial markets. And the stimulus takes many forms. It's zero interest rate policy by the Federal Reserve. It's quantitative easing. It's buying bonds in the market to try to lower long-term interest rates to stimulate economic activity. This is a big discussion, and everybody will be stupider who's listening if I dilated on it for too long. I mean, what you need is a panel of economists to disagree with each other so everybody can see that nobody knows. What's clearly true is that the stock market is a huge beneficiary of this, of easy money. And what also seems sort of true is that for some time now, the Federal Reserve, in my view, has spent too much time worrying about levels in the stock market. That I feel like government policy seems to respond to stock market levels as if keeping the stock market up is actually a goal rather than something that should just happen. And the stock market should go where it goes, kind of thing. Does it contribute to instability? It certainly doesn't, in any direct way, play into the story of market structure that I'm telling. So I would say no. But I'd also add that the problems that, say, Ben Bernanke faced when the financial system basically collapsed in 2008 the decisions they made to deal with the problem with money was, I think, whether it was ultimately right or ultimately wrong, I think it was a very brave decision. I think it was probably right in that, given that the government was was paralyzed, it was the one way to sort of prevent a depression from happening. And everything that happens after that is a secondary concern. So I actually think Ben Bernanke is an American hero. I do. I think what that man did is incredible, and he's taken all kinds of grief, and I've said nasty things about him, I'm sure. I mean, it bothers me a little bit he didn't see the subprime prices coming, but I think given the hand he was dealt to play, he did what he could, and I think a lot of people would have done the same thing, knowing what he knows. But anyway, that's all I have to say.
Do you foresee a class action suit at some point, given what you've written?
I
in
hate
some of the
lawsuits.
issues?
You just want the problems to be fixed, right? You don't like that's like I hate this zero-sum bickering between political parties. You just want people actually in a room. All they want to do is fix the problem, right? And that's what these guys are. Here, and they've given you a solution. Here's the solution problem. Let's just do this, and let's not worry about lynching people, figuring out the names of the high-frequency traders who've done all this, like embarrassing people on national TV. It's just not necessary. The more of that there is, the less likely there's a solution, because the people who have been perpetrating the problem feel like they're really exposed. I think it's sort of like, let's just fix it.
Do you think Congress and the SEC have the technical ability and knowledge to look at this problem?
Yes, I actually do. I do. Now, of course, the question is the money that's funneled into the process by the people who are making lots of money for these advantages on the exchanges going to overwhelm the debate? I mean, what you will see is a fog machine in Congress and a fog machine inside the SEC with lots of numbers and data that actually don't mean very much or are false or whatever. But there'll be an argument against doing anything. But my hunch is that now the problem is exposed in the way it's been exposed, that the problem can be dealt with. Actually, the regulatory process can do the things it needs to do, which isn't necessarily to introduce one new regulation. We've seen what happens when they introduce a very well-meaning regulation. I think the two things that people in Congress who are concerned with this issue and regulators should always keep in mind is that everything should be in the direction of increasing transparency. I mean, genuine transparency, not theoretical transparency. But people will actually know what's happening rather than if they dig through 800 documents and read the fine print, they'll know it. And so actual transparency, and two, being very sensitive to the incentive system they're creating in the financial markets with what they do, because people are just responding to incentives. I mean, that's the story of Wall Street in the various crises we've had, is people just like answering the call of incentives. And when the incentives are bad, the behavior is bad. And you're not going to change the behavior unless you change the incentives.
And finally, Michael Lewis, I was a little confused by the last chapter. And we don't need to tell everybody what it is. They can pick up the book, Flash Boys, and read it for themselves. Is the last chapter, are you previewing your next book? Are you previewing Bigger, Better, Faster? Or something else?
So the book ends. It's going to take a long time to get to finish this, but let me just briefly. The book ends with me on a bike ride, riding along a fiber optic cable that was laid between Chicago and New Jersey to cut off 2 milliseconds in the time a signal traveled. 4 high-frequency traders. Cost $300 million. No one knows why that lane. I mean, no one who was around that line being laid knew what its purpose was. This thing is, it's like a beast underground, and I went riding along it on a bike, and while I'm riding on the bike, there's a newly constructed chain of microwave towers hovering on the hills in Pennsylvania over the line. And those microwave towers are there because they're able to move a signal a couple of milliseconds faster than this line that was put in 3 years ago. And the mystery is who did that. So I ride up to one of the towers and I list the number, the FCC number, on the tower, and I say, go figure it out. There's an interesting story about who did this and why. It's not my next book. But at the bottom of this story is the question, do people want to know enough to go and find out how our markets work? And it was just a challenge to the reader. Go on the internet. You can figure out what's going on here.
Subtitle of Wall Street Revolt, Flash Boys is the name of the book. Michael Lewis is the author. Thank you.
Thank you.